Private equity and venture capital are two distinct forms of private market investing, each targeting different stages of a company's life cycle and employing unique strategies. While both aim to generate outsized returns for investors, their approaches to risk, operational involvement, and exit timelines can diverge significantly. I would like to examine their key differences through a more systematic framework. Regarding the investment stage, venture capital targets early-stage startups, often pre-revenue or in the seed or Series A funding phase. The goal is to identify potentially high-growth companies in disruptive technologies or business models. In private equity, the targets are generally mature, established companies with proven cash flows, often undergoing operational or financial restructuring, whose acquisition aims to optimize efficiency and expand market share. We could say that venture capital focuses on scaling innovation, while private equity emphasizes transformation. Regarding the risk-reward profile, risk can be characterized to be high in venture capital, and by high, we can quantify it with a 70 to 90% risk of failure. Whereas in private equity, it's only moderate, since it tends to be backed by tangible assets and already existing cash flows. At the same time, the return expectations are pretty different as well. In venture capital, given the high exposure to risk of failure, the venture capitalist has an expected return of 10 times, perhaps even 100 times the capital invested. Whereas in private equity, it's only 2, 3, 4 times the invested capital. Portfolio diversification is a very important feature for venture capital funds because of the high risk of failure. While private equity investors, though in need of diversification as well, have relatively more concentrated investments with active control. Their level of operational involvement is also different. In venture capital, the venture capital investor enters in an advisory and strategic support relationship. Venture capitalists provide mentorship, industry connections, and growth capital, but rarely assume operational control. The investment structure implies usually minority stakes with board seats. Whereas in private equity, the private equity firm has an active management role by often replacing leadership, implementing cost-cutting measures, or pursuing mergers and acquisitions to enhance value. The investment structure entails a majority or full ownership, enabling direct operational changes. The exit strategies for venture capital investors are usually IPOs or acquisitions by larger corporations within 5 to 10 years, contingent on the startup achieving scale. In private equity, we see trade sales to other strategic partners, secondary buyouts selling to another private equity firm, or recapitalizations on a 3 to 7 year timeline, often accelerated through operational improvements. Finally, for an investor, the considerations we can draw are that a venture capital allocation implies a higher degree of risk tolerance than that of private equity, where more predictable results are preferred. Venture capital requires a longer investment horizon and a skill set with industry expertise, whereas in private equity the skills required are operational turnaround and that of financial engineering. Venture capital and private equity serve complementary roles in the investment ecosystem. Venture capital fuels innovation by funding high-risk, high-reward ventures at their inception, while private equity maximizes value in established companies through operational and financial engineering. Investors must align their capital, expertise, and risk appetite with the appropriate strategy, or combine both for a diversified private markets portfolio.